Hey there, everyone. Dave Keller here with Market Misbehavior. Welcome to Chart This with Dave Keller for Friday, March 13th, 2026. We're coming to you from now dark, but generally sunny Los Angeles, California. Just got down here. Apologies for the late kickoff. I kind of had a feeling this was going to happen. I did not realize we were going to get a full on blizzard overnight in Seattle. The conditions in Seattle today were pretty awful for travel. Ended up getting delayed about 4 hours getting out of SeaTac, flying down to Burbank, and then coming into Los Angeles. I'm down here for board meetings at a music school where I'm on the board, and was super excited to get down here. Was expecting to get down here this afternoon, so I would have plenty of time to do a live stream. It just didn't play out that way. So I appreciate you guys being patient as I completely flip the script and change the plan and just go with the recorded video today. We will plan to be back live on Monday the 16th. So we'll see you then. But plenty to talk about here today. We're going to talk briefly about the market conditions today. No real change to the risk-off environment. A couple comments to share with you in terms of what we learned. But I would say, honestly, the biggest news today was less technical. It's more about the economic data, right? One of the things that we learned here in the last 24 hours that the GDP from the fourth quarter lower than expected, right? And this is one of the challenges you have with economic data. The stock market is forward looking. That's why it's a good leading indicator for the economy. The economy is rearward looking, right? It has a rear view mirror, and it tells you what happened a while ago. Now there are estimates about GDP, but now the actual data comes out and turns out the economy grew a lot slower than was originally anticipated or was originally estimated. So, the previous data is getting downgraded, and that just sort of, I think, is getting investors recognizing all the challenges facing the U.S. economy, events in the Middle East not helping. As a result, we remain in a risk-off environment, I would say, at this point. Let's do a quick recap, and then I've hand-selected 5 or 6 questions that I grabbed off of our YouTube channel. Some of these came from our live streams during the week. Some of these actually came from comments on our YouTube channel. You are welcome to throw questions in either location at any point. If you're just watching this on our YouTube channel, just drop a comment below the video with any questions you'd like me to consider. We'll hand-select another group to feature on next week's all mailbag episode. Let's talk about the market conditions here. So here's what happened yesterday. What was interesting today, we had a kind of a stronger open, and the S&P bounced up to around 6730, but we can see that by the close, we were back down to the lows of the day, and essentially the rest of the day was pretty rough. The S&P ended up closing down around 6632, so we were still above our big line in the sand. That difference from the green bullish area to the yellow, from the yellow neutral area to the red light bearish area, which is 6550. But 6550 is less than 100 points away after this week. So we are down 0.6% today. The NASDAQ down almost 1%, and mid caps and small caps outperforming, but still down for the day. The VIX actually, interestingly enough, actually remained fairly stable. As you look at the little preview chart here, as the S&P opened kind of strong, the VIX did drop to just slightly below 25, but then quickly came back up to just around 27, spent the rest of the day between 27 and 28. So we remain in a high volatility environment. We did get a question about the VIX to consider here today, which I did grab. So we'll talk a little bit more about the volatility conditions here in a short while. We talked on yesterday's show about the concerning development with interest rates. Interest rates have been trending higher. The dollar's trending higher. That's up another, almost 1% today. So stronger dollar, I would argue at this point, is less about, a lot of times there's a stronger dollar and it's about a flight to safety. It's about, people sort of rotating to U.S. assets. I think this is more about non-U.S. currencies not looking particularly great. I think the events in the Middle East and how they are unfolding as the week progressed, raising a lot of concerns about the global economy, particularly non-U.S. markets that are much more dependent on oil from the Middle East. The U.S., of course, at this point is energy independence. We've got enough oil, but disruption to the global supply of oil can cause ripple effects. You got to remember that most U.S. companies make a lot of their revenues outside the US. And so when the non-US economies are threatened, it's usually going to translate back to pressure on the S&P 500 companies, which are generally big multinational companies with a lot of non-US revenue. So stronger dollar here. Remember, currencies are a kind of a zero-sum game. So if the dollar's stronger, it means the dollar is strengthening versus other currencies, which are, of course, then weakening versus the US dollar. And I think that's the real story here, looking at Europe and developed Asia as well. Bonds did move lower. The TLT was down about 0.5%, and the 10-year yield continued to push higher, very close to pushing above 4.3%, which would certainly be a new swing high. Continued pressure on gold and silver. We can see gold trending pretty consistently lower over the last couple of days. We're going to look at that in a little more detail and share some insights with our market misbehavior premium members over the weekend. So keep an eye on that. Premium members, we'll talk about perhaps silver as well. Both of those, continue to rotate lower. So if you're looking for gold to be a safe haven, we're not really getting safe haven vibes from the yellow metal right about now. Crude oil prices, of course, continue to go higher. This is the USO, which is a crude oil ETF, pushing $120 a share. It actually got up to around 121 earlier today. Bitcoin did spike all the way up to almost 74,000, but as of recording this late in the evening Pacific time on Friday, March 13th, Friday the 13th, that is, Bitcoin actually trending lower, nearing that 70,000 level again. Just to finish off, no real alleviation of the negative breadth conditions, although the breadth in the S&P was actually neutral, if not slightly skewed positive, with 53% advancers and 47% decliners. But we're 38% of the New York Stock Exchange up today, 60% down. So breadth has been negative essentially through the course of the week. And we'll talk about that because I did get some questions on breadth conditions as well. Meg 7 names struggling here, and I think that's one of the real, takeaways from today's session. Continued weakness in Broadcom, failing to break above and hold the breakout above 350. Continued breakdown for Meta, making a new monthly low. Continued breakdown for Apple, making a new monthly low. And the concern I have about this market is that this is what Apple looks like, and Apple's almost a 4 trillion market cap company, right? When leading names like this are struggling, there's just no real opportunity for the benchmarks to be anything. At best, the benchmarks are going to be okay, but they're certainly not going to be good to great. And when other things are weakening, and that's what the weaker breadth conditions are telling us, just tells you stocks are very much in a risk-off environment right now, and that's very much our general assessment of things. Just to show the chart of the S&P rotating lower, I did get some questions on the S&P chart. I grabbed a really clever question, which I'll share with you in a minute. But, of course, this week was pretty much an ugly week. We had that bullish engulfing pattern, which seemed encouraging, but that was it. After that sort of 2-day reversal pattern going into this week, the rest of this week, solid candles, lower closes. The 200-day moving average is not too far away from today's close. I think going into next week, that's certainly going to be one of the key metrics to watch. 6550 to 6600. That's our initial downside target, given the break of 6800. Looks like we're approaching that very, very rapidly. We'll have a lot more on the market conditions for our premium members over the weekend. So guys, keep an eye peeled on that. But I would love to reuse the remainder of our time to get some of these awesome questions. As a reminder, these questions come from people like you watching the show and just dropping a question during our live stream or putting a comment on our YouTube channel. I read everything that comes in, and I appreciate you guys sharing some questions. Feedback, always helpful. Words about how the show has helped, please keep sending that because that's such a feel good, and it really does, help me recognize that it's having value for you guys, and I really appreciate that. But man, your questions are great because it gives us some great stuff to talk about on a Friday evening. Shall we get to it? First question, is there a magic VIX number where you go from, quote, elevated fear to, quote, watch out, this could get ugly fast? I love that that's the rotation. Curious if 25 and 30 mean different things to you. It's a really awesome question. I try to sort of sprinkle this kind of stuff in during the show, but probably don't make enough time for it. So let me show you the chart of the VIX, and I'll share with you just kind of how I generally think about this. So as a reminder, right? I mean, if you've not really followed the VIX before, which I can't imagine you haven't, because it's referred to so often. And to be honest, listen, a lot of other markets, right? The U.S. markets are we're very fortunate if you're trading the U.S. markets because they're a very transparent market. And what I mean is we've got a lot of color on conditions around the market. We have obviously a very liquid equity market, meaning there's a lot of trading. So we've got a lot of data, right? Price data is plentiful and we can analyze all sorts of trends on different timeframes. That's awesome. We have other derivative markets that are tied to stocks. We have futures markets. So when the US equity markets are closed, we've got Globex futures so we can see what's happening in real time. We've got the options market, so we can look at options pricing and premiums. We can look at volatility, which is what the VIX is telling us, right? Its volatility is implied by S&P index options. We have sentiment data, we have breadth data. So I feel like we have so many great opportunities to understand the markets, and just other markets just do not have as much data off usually, and in some cases are less liquid and less transparent. As a result, it's just tougher to get a read on all of these things. We've got a lot of information to consider. I think the downside of that is there's a very real issue, a very real potential for analysis paralysis. Right? I guess so much information, so much great data, you can't do anything because you got a fire hose of data coming at you. So I think being thoughtful about what evidence you consider and how you think about it is important. So for something like the VIX, I find it's often talked about, but for me, trying to just keep a clear head and focus on key levels to pay attention to, I think are very valuable. So when I'm looking at the VIX, first thing I will tell you is I usually look at the VIX like this on a closing basis. The intraday movements on the VIX have huge spikes. It's a volatile data series at times, and so for me, a lot of times that's just noise. I try really hard to pay less attention to noise and more attention to signal. And one of the ways you can do that as a position trader is not pay too much desperate attention on what's happening every moment during the trading day. I take a check during the after the open, just see how things are playing out. I usually check on the markets midday. I usually check on the markets going into the close and then soon after as I'm preparing for the market recap show, but I don't stare at it all day. And one of the ways that you can kind of not lose your head during the trading day is on things like the VIX. Just check it at the end of the day. Don't worry too much about what's happening moment to moment, because in big moves, you're going to find the VIX is very, very noisy. You don't want to draw too much of a conclusion based on that noise. So for me, looking at the VIX at the end of the day, just seeing where did we end up, right? And where are we at relative to some key levels. So that's one point is I found looking at it on a closing basis just is a much less anxious, much more mindful way of thinking about volatility over longer periods of time. Second thing I'll tell you is I pay attention to a couple key levels, and I will tell you these are general guidelines, which you really have to remember. And this is something I've talked with Dave Landry, who's a great trader and educator. He and I have talked before about how the VIX levels are not necessarily static, and I think that's fair. There are times when we generally have a lower volatility environment or a higher volatility environment, and I might actually still have some lines on this chart which speak to that. Yeah, so I used to put these on here a lot more often, right? I usually think about volatility regimes. So there are times like in 2022, which is more of a bearish market phase, the whole range of the VIX kind of moved up. You see that, right? So we never really got much below 20. We often got well above 30. Then in 2023, first half of 2024, low volatility environment. The VIX often got down to 12, rarely got above 20. So, just thinking about a level like 28 or 29, super helpful maybe in 2022, but like useless in 2023 because we never got anywhere near there. So that is true, right? Where the VIX will actually go through volatility regimes. That's fair. But I have learned that a couple key levels just have generally helped me understand, what the volatility is telling us. And the three levels that I'll tell you are most important are 16, 20, and 29. Why those? The way the math works out on the VIX, and I'm skipping any of the mathy parts of the math and just kind of giving you the general takeaways. A VIX around 16 essentially means the options market is pricing in about a 1% daily move in the S&P. That's what it means, right? So if the VIX is at 16, that means the options market's saying we're probably betting on about a 1% move, and not necessarily 1% move up or down. It's either one, right? That's the level of volatility we should expect from from the S&P 500. VIX above 20, for me, I have just found using this indicator for many, many years, anytime the VIX is above 20, it's a high volatility environment. For me, that means expect stops to more likely be broken because the daily ranges are going to be bigger. Expect bigger swings in the S&P and the NASDAQ. Expect bigger movements, and usually bigger movements happen on the way down, right? Because there's panic, there's elevated anxiety that usually causes people to make aggressive moves. That usually doesn't happen in a happy bull market. That's usually in a bearish rotation. So VIX above 20 for me has ended up being just a good like back of the envelope. Are we in a high or low volatility environment? High volatility environment, I just need to be mentally prepared for the fact that we're probably going to have bigger swings, and I need to make sure that my stops are updated. VIX over 29. This came from years ago. I interviewed Tim Hayes, the chief strategist at Ned Davis Research. If you don't know Ned Davis Research, wide following in the institutional community. Ned Davis is just a fantastic market practitioner, educator, researcher, a very data-driven process, which I always found really, really helpful. They always did some really cool custom work that I found really, really valuable. In their work, right, Tim shared with me years ago in an interview, in their deep dive on decades of history of the VIX, anytime the VIX spikes above 29, it usually means we're in a big time corrective move. And the returns, once the VIX pushes above 29, are pretty bad, at least in the short term, because that's how major bear markets tend to happen. So had some others. So those are some of the key levels that I watch. That's how I think about volatility. And I brought up this 5-year chart just to show you that if you wonder, like, why are you concerned that the VIX is spiking up? Like, look back here, right? When 2021, the VIX is kind of between 16 on the lower end, and it got above like 20 a couple times, but didn't stay up there too often. But then look at how in the fourth quarter of 2021, we spiked all the way up to 30. And then look how we never really got below 20, right? So the VIX kind of up in an elevated range is usually during this kind of environment. So when I see that initial move above 20, I'm immediately thinking back to this right here and thinking, wow, those big spikes with the VIX up above 20, up to around 30, that's what late 2021 looked like before a major market top and then a really painful, 8 or 9 months down to the October 22 low. There's no guarantee that the VIX going to 29 means that same thing is going to happen. But this is what cyclical bear markets usually do, is you have a big spike in volatility. So the flash in the VIX spiking higher in the way that we've observed so far in 2026 looks a lot like right around when a market has started to top and you start to see some really negative returns. And so that's why I think of the VIX that way. I hope that answers your question. That was a long-winded kind of roundabout answer, but that's my story. Next question. How often do you use correlation measures when evaluating a position for your portfolio? I don't show them often here on the show, but I do use them regularly. And honestly, my use of correlation went back to when I was first learning about investing. This is when I graduated from Ohio State with music and psychology degrees. So kind of a non-traditional path into the financial industry, but I will always be thankful for Bloomberg that thought it was a great strategic decision to hire a bunch of liberal arts majors like me from random schools like Ohio State, bring us to New York and teach us all about investing. And I think their thinking, which I embraced, and then when I was starting to hire people, I completely bought into this idea. You get people that were good at speaking and good at asking questions and good at listening, ended up being pretty good for training and sales and education. And then you could teach them the subject matter, right? It was more about, can they take the subject matter and engage with customers and potential clients and have that information resonate. And I found that was something I was pretty good at. And they, of course, thankfully did that. Long-winded way of saying, I learned about correlation at Bloomberg because you would always look at a correlation matrix. It was this really old school kind of text-based screen where you would see a bunch of things down the left column, bunch of things down the top column, and then it would just fill in this table of correlations. And so that was really helpful to just identify which of these assets have strong relationships, positive relationships or negative relationships, which things have very little relationship, which is really helpful too, because those are called non-correlated assets, right? Stocks and gold are two of those that are pretty common. So how do I use that now? Well, I use it on stock charts actually pretty often. I also use it on Optima. which are two places that I've found correlation tools to be pretty helpful. There's an indicator on stock charts under here called statistical correlation. So it's going to default to 20 days to the S&P 500. So here you can actually change which thing you're correlating it to. And we're doing a 1 month correlation. It's basically a trailing 1 month correlation. What's the relation, the nature of the relationship between these two data series looking back for the last month is how I would generally interpret that. So we're looking at the GLD and I'm comparing it to the S&P. Look at where the correlation is. So far in 2021, it's been pretty close to zero. And that's actually good. A lot of people think of the stocks and gold as having an inverse relationship. So if stocks are up, gold's going to be down because you don't need gold. When stocks are down, gold's a safe haven and gold's going to go up. But the reality is sometimes stocks and gold go up together. So for example, September and October of last year, stocks doing fine, gold's doing great, correlation almost +1. I mean, above 0.8. That's pretty strong positive correlation. Then all of a sudden by November, you have gold in a major pullback. You have stocks continue to go higher. All of a sudden, the correlation for the last month tips dramatically negative. Generally, the relationship between stocks and gold, if you look back over time, zero, right? I mean, right around zero. And so gold's value in a diversified portfolio is the fact that it just usually doesn't track gold consistently, which means if you're concerned about stocks, you don't necessarily want to be in things that are always up when stocks are down. You just want to be, looking at things that are doing something completely different. So what you will find if you start poking around with this, right? So here's the QQQ and here's the SPX. Correlation, not surprisingly, dramatically higher. The correlation's almost at 1, right, for most of the time, because the S&P and the Nasdaq, while they will have different percentage swings, they will have sometimes where they're doing something different. Pretty rare, right? Most of the time, they're doing the exact same thing. So if you own the S&P and the Nasdaq, you're just not. You might as well just own one of them and make life a little bit simpler. And where I find this is helpful when you're constructing a portfolio is I found very often individual investors fall into the trap where they own a bunch of different stocks, but the correlations are so high, they pretty much just have one bet that they're making. And this is something we would do with the institutional investors is run this on a portfolio level and just find like, where are you making these bets that are actually the same bet? And like, why don't we don't need to make it multiple times. Like, let's just make one of those bets and then use the other capital to do something else. So that's how I use correlation. If you can find a platform that has it in like a matrix, I found that's really helpful because you can dump a bunch of tickers on one side and the other, and you can scan and find things that have low correlations. That can be really, really helpful to just help you understand the nature of your portfolio. All right, next question. And you're calling out my good friend and fellow stock charts contributor, Tom Bowley. Tom Bowley emphasized most U.S. indexes have their AD lines going through the roof. That sounds like something Tom would say. He's usually pretty bullish about stuff. And I say that with a great deal of respect. Tom's awesome. And I think the world of him and his work. And so the AD line's going up so much could signal smart money quietly buying. That is true, right? I mean, the advanced lines are going up. That does imply that a lot of capital is being, pushed on stocks going higher versus lower. That would make sense. At the same time, most other breadth measures look quite pessimistic. Question mark. Interesting. So I didn't see whatever report or video that you're referring to that Tom did. I mean, Tom's pretty solid, so I'm going to assume whatever he's saying is grounded in some fantastic chart that I don't have access to at the particular moment. So not seeing the context of what he said, what do I think of it? So I guess I would say I would kind of agree with the assessment that 8 advanced decline lines have been going through the roof. I think that's true through the end of February. I don't know if I would describe the advanced decline lines so far in the month of March as going through the roof. To the contrary, I think they're more going through the floor. Now, having said that, right, if you zoom out enough, is the larger trend in the advanced decline lines really bad yet? Like, no. But I mean, is the larger trend in the S&P 500 really bad yet? Like, no, right? I mean, we've broken down some initial support, but like we're still above the 200-day moving average. All the AD lines are still above their 200-day moving averages. Like the trends are not that bad. But I would say the advanced decline lines have definitely changed character from January and February, where they're all making new 52-week highs. to March, where they're all rotating lower. So, again, so I would say that the difference is probably a question of time frames, because different breadth indicators really are thinking of different time frames, right? So the McClellan oscillator is derived from the advanced decline data. It's kind of looking at the slope of the advanced decline lines. The way it's calculated is what it's essentially doing. So when the McClellan oscillator is below zero, that means the advanced decline line is slowing down and or going down, right? And the McClellan oscillator above zero means it's starting to slow down its downtrend and or starting to go higher, right? So it's like the rate of change of the advanced decline data. So the McClellan oscillator has been bearish since the end of February, and so that matches what we saw in the previous chart. So short-term breadth indicators like the McClellan oscillator, like the percent of stocks above their 50-day moving average, all have gone very, very negative here in March. Longer term measures of breadth, like the advanced decline lines, broken, down, but not, completely broken yet. Percent of stocks above their 200-day looked like, as of Friday's close, still right around 50%. Or slightly, I mean, we're right at 50%. That's a rounding error. So we're still at 50%. So, I mean, percent of stocks above their 50-day down at 32%. That's pretty bearish, but the longer term breadth is still okay. So I would say it's probably a question of the time frame we're thinking about. Longer term breadth indicators are still okay. Short term breadth indicators have gotten very weak. And so the issue I have is short term indicators will always trigger before long term ones, just the way the math is. So when you see the big weak rotation in the short term indicators, you have to start to think about what would make those long term indicators get more negative. So for me, the advanced decline lines breaking below their 50-day, that makes them neutral at best for me. So I would not say that, in my opinion, they're not, they're not remarkably strong now. I would say they're neutral at best at the moment. All right, we do have a couple more questions to share with you, but I do want to give a quick shout out to one of our longtime partners, Seeking Alpha. If you go to marketmisbehavior.com/seeking alpha, you will learn about some of the tools that I found quite helpful over time. One I'm highlighting here this week is the health check. It's like taking your portfolio to a wellness check. We would often, when we were working with portfolio managers at Fidelity, tell them that sitting down with the technical research team was like taking your portfolio to the doctor for your annual physical. No one wants to do it, right? You don't do it because you don't want to hear anything bad, but you're always glad that you did, because if you catch something early, it's always a good thing. This is preventative medicine for your portfolio. They have this health check where, using their quantitative model, they can actually show you how your portfolio is stacking up. And so basically you can focus your attention on the areas of potential weakness. I'm also a fan of how Seeking Alpha does some really cool dividend analysis for individual names, but also for at the portfolio level, to help you think about cash flows through the course of a quarter as different companies in your portfolio are paying dividends. I also like their scanning tools built around their quantitative model, which I think is pretty excellent. You can find more information about their premium memberships at marketmisbehavior.com/seeking alpha. If you use my link, you get 10% off, and it's a pretty cool platform. I hope you can check it out. Also, just so you know, next Thursday, March 19th, 1 p.m. Eastern, I'll be doing my next free webcast called From Model to Market: How Mindful Investors Evaluate Trends. Our medium-term S&P 500 market trend model just turned bearish about 2 weeks ago. I'm going to show you how that market trend model was designed. I'm going to show you how it's calculated, how I use it every week to evaluate market conditions for my premium members. And I will also apply that market trend model to a number of different ETFs. We'll look at some different asset classes, some global ETFs, because given how the world is changing here, I feel in March of 2026, important to think about multiple timeframes. You can sign up for that free event at marketmisbehavior.com/model. I hope you join me for that free event coming up next Thursday. Next question, Dave. If there is a significant pullback in the S&P 500, will we still be in a secular bull market? If so, when is your prediction on when that ends? Wow, one thing you will not hear me do is predict when a secular bull market will end. That is a water cooler discussion. Yeah, I'll speculate for sure. So hey, let's go there, right? And here's what I would say, right? As a trend follower, I learned a long time ago, my goal as a technical analyst is not to have a crystal ball, not to have tea leaves, right? This is what, when I first learned about technical analysis, people would, talk negatively, talking about it's just looking at tea leaves. It's like a crystal ball. It's a bunch of BS. And what I learned was that the people using technical analysis, at least that I was exposed to, that really had great results with it. They weren't trying to predict the future. They were just analyzing trends that were happening. They were using tools and techniques to anticipate turns, but it was more about validating those turns and just having good awareness of what was happening. That has served me well with a number of investors over the years, and I hope that how I apply those trend following tools on the show helps you make sense of things. So your question was, how does this impact like a secular bull market? So number one, if you're talking about secular trends, you need to bring in a lot of data. If you're talking about secular trends, I'd be looking at a monthly chart of the S&P 500. We're going back, oh, what the heck, 50 years, right? Secular market trends are longer term trends, right? These should be lasting over a decade. Generally speaking, bull markets last in the 16, 17 year-ish kind of time frame. That's kind of the general basic trend about secular bull markets and secular bear markets. It can often be longer than that, and we're arguably experiencing one of those longer periods maybe right about now, but we'll see. And what I mean is, right, look at 2000 to 2013. 2000 is when the tech bubble essentially started to burst. This was S&P 1500. We retested that in 2007. There's the great financial crisis. We finally made a new all-time high and broke above 1500 again in 2013. I would say that's a secular bear market, right, during that period. Until we may break out to new highs, I would say that secular bear market is still in play. So within a secular bull market, you have cyclical bear markets like 2000 to 2002 and 2007 to 2009. You also have cyclical bull markets from 2003 to 2007 and 2009 to 2013. So these are more, general labels, but a secular market is more of a larger, big, multiple, huge cyclical shift from bull phase to bear phase. So we had a big, secular bull market from, essentially 1983 when we finally broke above Dow 1000 to the market peak in 2000. We then had a secular bear market until 2013 is how I would label it. I think we've been in a secular bull market from 2013 to present day. So right now we're about 13 years in. Generally, secular bull markets last around 16, 17 years, generally. But that's a generalization. That's an average, right? So we can be shorter and we can be longer. So based on that math, we probably have a little bit longer before we would start talking about, wow, this secular bull market has lasted a lot longer than expected. But having said that, right, it's way too early, right? You're kind of here. It's just way too early to be talking about a secular bear market, right? I would argue, right, it's maybe even it's too early to be saying we're in a cyclical bear market. I don't know if we're in a bear market yet. We haven't even broken the 200-day moving average. Things aren't that bad yet. So before we get too excited labeling things as a cyclical bear market or bull market, then we need to be analyzing more about the trends and what levels we're breaking. I hope whoever asked that question, hope you can attend my webcast next Thursday. We'll be talking about multiple timeframes and how I use my market trend model to try to make some of those assessments as well. And I hope that helps. I love this question so much. So I don't call out on the mailbag show who actually asked this question, but whoever did, A+ question, because I love where your head is at. Does it make any sense to flip the S&P chart upside down to get a sense of a serious trend change? Can Fibonacci rules be applied this way as in the usual manner? So the short answer is yes, it makes sense. And the short answer is yes, you can apply Fibonacci rules because the levels are kind of the same. What you're doing when you look at a chart like the S&P 500 and you flip it upside down is something truly magical, right? Here is the chart of the S&P 500 going back for the last year and a half. Now let's invert it, right? So if the question is, boy, the S&P looks toppy, you can invert it and say, does this chart look like a good bottoming chart? If this chart was a stock, would I buy it here? And if not, where would I buy it? So I will give you my honest assessment, having just done this. At what point would this chart look like a pretty good buy? So for me, I would say we've been in a downtrend, obviously, for quite some time, but we're obviously rotating higher, making higher highs and higher lows. That tells me we're in a bullish phase. breaking above the 200-day for me would probably be a very big, as we always say. I mean, I often say, right, nothing good happens below the 200-day. So getting back above the 200-day would be meaningful. I'm also noting these highs in October and November, right at that level. So I would say getting above this price point, which would be 65.50. I think that would be important because that would be breaking above the most recent major highs and also clear the 200-day moving average. Now, it's not surprising, and I'm being totally honest. That's what I'm seeing. But obviously, this is very much in line with this right here. The idea of flipping the chart does something really cool to our brains. Is it helps us disconnect from all of our preconceived biases about the fact that this is the S&P and everything that that means. All of a sudden, we're just looking at a chart and we're thinking about key levels and key breakouts and breakdowns and key levels of support and resistance. On stock charts, by the way, you can invert a chart by adding a little minus sign before the ticker. Good platforms that I use, like Optima and others, also give you the ability to invert the scale. If you don't know how, it's in there somewhere. I don't remember, like on Optima. I'm pretty sure you like right click on the price series, and then there's an option to invert the scale, if I remember right. But I've found that to be helpful. This is something we would always do, as a way of just, the problem when you look at enough charts is you have biases that you're bringing with you. And if you can shake that up a little bit, flipping the range upside down is a great way of just sort of looking at it with kind of a fresh perspective. And so, yeah, to answer your question, it makes a ton of sense to flip it over. It makes a ton of sense to use Fibonacci retracements because the math works either way. It's either way is fine. So I would encourage you to check that out. If you're doing Fibonacci retracements, though, I would switch to arithmetic scale. Otherwise, you're going to get some really weird readings on the inverted log scale charts. Is the only thing I would caution you on. Final question, then we'll call it a weekend. Great show, David. I wish I'd found you a long time ago. Hey, I am happy you're here today. What would a standard operating procedure be for a newer trader working a 9-to-5 daily job somewhere else? I almost didn't take one more question, and I kind of wish I wouldn't because I want to give a longer answer to this, but I'll give a short answer and maybe a longer answer. I'll turn into a video on my YouTube channel at a point to be added later. So you're doing something else with your life. You're trying to trade. So number one, hey, congrats. I think that's awesome. It is such a fascinating opportunity to learn so much about so many things. Just the fact that and again, people make fun of, like, in this environment, everyone's an expert in geopolitics and in crude oil. I find that one of the coolest things about investing is you learn about healthcare policies and new drugs and how they're approved, and you learn about geopolitical events and what affects the price of crude oil and the dollar and how different economies, are fueled, pun intended. I think that's awesome. So congrats on getting into a thing an activity that hopefully allows you to grow capital in a responsible way, but also helps you learn. I love being a lifelong learner, and doing this is going to get you there. So, a couple things to think in mind. Number one, I would say one size does not fit all. You will find a lot of places and kind of snake oil salesman vibe kind of places where they kind of tell you, look, this is all you need to know is this one thing, and just follow this signal or whatever it is. Honestly, I would tell you most of that, in my opinion, is probably total BS, and it's probably exaggerated in some way. There's no one size fits all. I think what's better for you if you're just getting started is don't try to find the holy grail. Don't try to find the one thing that works for someone else. Try to find tools and techniques that fit with how you approach things. This is why advisors will often ask you about your risk tolerance, because that's a great way of just thinking about what kind of investor you are. Are you more risk averse, or are you more risk? You have a higher risk appetite, right? Are you open to taking on a bunch of risk in your portfolio? And that's one of the basic questions you ask to try to get a sense of someone. So same thing for you, right? How aggressive, how conservative do you want to be as a trader? I would encourage you to be a sponge, to read and learn as much as you can. If you're looking for ideas about stuff to read, to kind of expose yourself to other approaches, I have a recommended reading list on my website. Go to marketmisbehavior.com, go to reading list. You'll find a bunch of great books that talk about different things. And I hope something in here gets you thinking, whether it's William O'Neill's strategy, fusion analysis, combining fundamentals and technicals, um, reminiscences of a stock operator, which talk about like kind of the universal human factor in trading, which I mean, you should start there if you haven't already yet. Please do that. Stan Weinstein's book and others that have more disciplined ways of thinking about trading and trends. Obviously, the great technical analysis literature. It's all really fun stuff. But be a sponge and then start to find the stuff that is interesting to you that you think works for you, and then that's going to be your trading approach that's going to work. Second thing, start with small position sizes. I find when people get started, they usually go way too big. And if you have way too much of your portfolio in one position, if it goes great, you're going to feel like a rock star, and then you're going to be way too overconfident the next time. And if it doesn't go great, you've already lost a ton of money, which is not a good way to start. So either way, it's not good. Start with small position sizes. No more than 2% of your portfolio is what I would start with until you gain the confidence and the risk management skills to be able to handle larger positions. Third thing, the more actively you want to trade, the more time and energy you want to devote. One of the reasons why I'm a position trader, which means I'm looking longer term, months, if not years down the road, is because I have a family, I have a business, I'm an entrepreneur, I volunteer, I'm on the board of things like a music school, I go to church, and those things all take time and attention away from the market. So the only way I've found to be able to do all those other things that I'm passionate about and sing in a choir, do all that stuff, is by not staring at the markets all day. So I'm not a day trader. Part of the reason why is because when I saw what it took, I didn't want to stare at my screen all day. Being a day trader means you better be glued to the screen because you're making quick decisions all the time. And so the more actively you want to trade, the more time and attention. Where a lot of people run into trouble is they think they're a day trader, but then they don't really focus the time and attention that you need to be successful there. It's not going to work. I mean, it's just not going to work out. It's going to work maybe a little bit for a little period of time and make you feel really excited, but then it's just not going to. So I would be thinking about how much time and energy you want to devote to it. And if you don't have a lot of time during the day, which sounds like you might not, start with longer term time frames, swing trading at most in terms of actively trading. And just remember that you can set levels, you can set stops, you can do all that when the market's closed. And then when the market's open, you can make sure that your risk management is covered. Those are some of my initial thoughts. I want to give a lot more thought to that. And maybe I'll do do a longer video at some point with my standard operating procedures for new traders. But for now, we're out of time, folks. Listen, thanks so much for watching the show. I hope the answers to these questions made you think a little bit, gave you some ideas about how you can improve your own investing and your own trading. Sorry for the late kickoff and the random video tonight, but it was the best I could do, and I hope you find it helpful. Listen, have a wonderful weekend. Please stay safe with all the weather going around all around this country and everything going on globally. Stay safe. Be well this weekend. We will see you next Monday live for our market recap show. In the meantime, remember, it's always a good time to own good charts. Take care, folks.